Hi, I'm Ty from NAV. Borrowed capital fuels a lot of small businesses, as well as their larger siblings. Today we're going to talk about the small business loan process. We'll focus on the application process as well as some pretty common deal killers, regardless of where you apply. Although there are some differences between applying for a traditional loan at the bank and applying for an online loan or other alternative financing option, many of the processes are similar, even if the qualification criteria are different. Regardless of whether you apply for a small business loan sitting across the desk from a loan officer at the bank or through a simple online application, your application will go through an underwriting process. In other words, the lender wants to evaluate your application to see if you are eligible for a small business loan from them. They might not ask them this way, but there are basically 3 questions every lender needs answered before they will approve your loan application. Number 1, can you repay a loan? In other words, do you have sufficient revenue and cash flow to make periodic payments? Number 2, will you repay a loan? This is a little different question and reflects why your personal and business credit profile are so important to a lender. They're trying to determine what you will do in the future based on your track record. They're trying to determine if you will make each and every periodic payment. The last question is, do you have the ability to continue making loan payments even if something unexpected happens? When addressing this, my dad used to complain with something like, if I had that, I wouldn't need a loan. When I became a business owner myself, I came to understand his frustration. However, with that being said, the lender just wants to make sure you have the ability to make each and every periodic payment for the entire term of the loan, regardless of what happens within your business. After all, that's how they make money. That's also why traditional lenders want specific collateral, along with your personal guarantee, and many online lenders file what's called a UCC lien. No lender wants to see you default, nor do they really want your collateral, but they are trying to mitigate the loss should you default. Now, let's talk about some of the common deal killers that make it hard for your business loan to successfully navigate the underwriting process. Let's start with the underwriter finds an undisclosed loan, line of credit, or other cash advance. When you apply for a loan, the underwriter is going to evaluate your business on all the available data, and they can find out about you and all the data that you've disclosed, because data drives loan decisions. If you aren't being forthcoming with your current debt obligations and they learn of them through your bank transaction records, they'll likely pass on your questionable loan application in favor of another borrower. Another deal killer is excessive negative days in the month-to-date banking report. It's not uncommon for a small business to occasionally have a day when their bank account goes into the red, but those days should be the exception rather than the rule. Excessive negative days in your account not only tell the lender you're paying a lot of overdraft fees, it's also a big red flag that you might not have the cash flow to make regular periodic payments. Most lenders, including the SBA, also tend to shy away from borrowers with a recent criminal history. The SBA requires at least 5 years have passed since a conviction before they will even consider a loan application. And although there are some lenders who don't require as much time, the SBA's threshold is a pretty good rule of thumb. A tax lien isn't always a deal killer, but an undisclosed tax lien or a lien that's not in some kind of payment plan probably will be. Also, a recent bankruptcy will likely cause your application to be rejected. There are lenders that will approve a loan if the bankruptcy has been discharged for at least 6 months, but 2 years is more likely. As a general rule, the older the discharged bankruptcy, the better. Unsatisfied, excessive, or large judgments don't look good either. Remember, lenders are trying to determine what you will do in the future with their loan based upon what you've done in the past. Unsatisfied judgment from former creditors don't instill a lot of confidence that you will make your periodic payments. It's also difficult to get a loan approval if your ownership percentage is less than 50%. Lenders want to make sure you're an authorized owner in case of default. If not, they won't approve your loan application. In some cases, though, a managing partner with a smaller percentage of ownership can apply for a loan provided there are approval documents from the other owners. Another deal killer is a major drop in revenue. A major or sudden drop in revenue makes it difficult for a lender to assume you have the financial ability to make periodic payments. And your landlord can also kill your loan application. When the lender looks at your business credit report, which they will, if you are behind on your business lease or in the middle of an eviction, that's another red flag. Any undisclosed history of default or restructured debt or cash advance is a problem. The key word here is undisclosed. As a borrower, you should assume that a loan underwriter will find any skeletons you might have lurking in the closet. It's best to be upfront with any potential problems. What's more, don't forget, lenders are listening to everything you say. So you've got to watch what you say. For example, saying something to a loan officer like, "I'm selling my business," or "I'm trying to sell my business," or "I just lost my biggest customer and I'm not sure I'll be able to make these payments," will end up in an application being rejected. Remember, lenders are trying to determine whether or not you can repay a loan, you will repay a loan, and that regardless of what happens in your business, you'll be able to make each and every periodic payment as agreed upon. If you can do that, your loan application will likely not end up at the bottom of the pile. I hope this was helpful, and thanks for watching.